G'day and welcome to this introductory video on the VectorFX intermarket correlations indicator. So I guess by way of explanation, a good place to start is why did we create this indicator? And the intent behind it is to try to get an understanding of what actually drives, or what are the driving forces that cause currency pairs, which is what we're trading. It causes currency pairs to move or range, trend, whatever they do, to try and get an understanding of that. And I guess where this indicator is a departure from traditional indicators is that traditional indicators like MACD, RSI, moving average, whatever, what they effectively do is take candlestick data, and all a candlestick is an open, close, high, low. It takes that data, applies some maths to it, then represents it in a different format, being an oscillator or a moving average or whatever it is, which is fine. But I guess the issue with that is it's not giving you any idea of why price did what it did. It's showing you simply what price has already done. So it's giving you the result of what's happening, but not the why something is happening. So what we are trying to achieve is what are the forces that are moving a currency pair. Now, on the chart here, I've got the Euro USD, standard candlestick chart. What we're trying to do with this, as I mentioned earlier, is trying to identify the forces that move price. And the Euro USD gives us a really good example with another instrument known as the Dixie or the US dollar index. So TradingView has this cool compare button, or compare symbols, and I've already got one here for the DXY. So I'll just make that visible. Okay. So what you can see here is the chart that we had open before, which is the Euro USD, and the US dollar index. So what is the US dollar index? Now, the US dollar index is what is known as it's a synthetic instrument or a synthetic basket. And within that basket is a group of currencies. So it has within it the euro, the Japanese yen, the British pound, Swedish krona, and the Swiss franc. Each one of those currencies are weighted within the US dollar index. And what it gives us is an indication of US dollar strength or weakness. So why is this useful? Well, if you have a look at the Euro US dollar, it is made up of two parts, the euro and the USD, US dollar. Depending on the strength or weakness of each of these two components, that is what drives price for the Euro US dollar currency pair. So when the US dollar is strong or stronger than the euro, we would expect price to go down. And when the US dollar is weaker than the Euro USD, we expect price to go up for the Euro US dollar currency pair. And the DXY gives us a really good example of that. So just starting from the beginning here, we can see that the US dollar is weakening. Look what happens to the Euro US dollar pair. It strengthens. Now, if you look at this whole thing, it is extremely symmetrical. It's not perfect, but it is symmetrical 95 to 99% of the time statistically. So here's another example. The US dollar is getting stronger. What is the result of that on the Euro US dollar currency pair? It drops. US dollar, let's move this, is stronger than the euro, causing price to drop. And you will see this over and over and over again as we move this chart. And this is what is known as an inverse correlation. So as the US dollar gets stronger, the Euro USD currency pair drops. And as the US dollar weakens against the Euro currency, Euro USD currency pair rises. Now, as cool as this principle is, you can see on the charts it's a jumbled mess, and this is where the indicator helps. So we'll hide the Dixie. Actually, delete it. Come to indicators and invite only scripts, and come down to intermarket correlations, and we'll put that on our chart. And we're going to see something like this. Now let's talk a little bit more on the indicator. So we saw the example of the US dollar index, or the Dixie, versus the euro, and we saw the inverse correlation or relationship between the two instruments. So we thought, well, if we can see or can come up with a synthetic instrument for the US dollar, and that's useful looking at direction for the euro US dollar currency pair, why can't we create synthetic instruments for every currency? So if we can come up with a synthetic index for the euro and then a synthetic index for the US dollar, we then have two indications of strength of the euro US dollar currency pair. And that is what we have done with this indicator. Now, there are a lot of inputs for this indicator, as I'm about to show you. But what we're going to do is give a really simple example of how it works, and how we can use correlated and inversely correlated baskets to see price movement. So even though there are, as you'll see, a lot of inputs, we have currency pair presets. So you can just come here and select the one that you want to trade. Now we're currently trading on the 5-minute time frame, so we have a set of predefined baskets for these currency pairs. So we're looking at Euro USD. So I'll select Euro USD, and you'll see it generate. Give it a moment. There. Right, there's a lot of stuff. And we will we'll go into we'll explain each of it, but we'll just start from the very, very basics so you can see how this works. So now you can do this yourself. You can do this on any of these currency pairs. It's fully customizable, so you can come up with your own synthetic baskets. But what we're going to do is simplify it for the purposes of this example. So we have synthetic instrument 1, which gives us the a line for the direction of the euro. We'll turn that on. We have a basket here for the US dollar. We'll turn that on. We'll come down here, turn show custom synthetic spread off. And as I said, we'll go into explanation as to what these mean. We'll turn off enable color candle coloring. We'll turn off enable component fill, or is what we call the snake. And we'll turn off show bond yield spreads. And select OK. And this is what we get. Right, we're back, and with the indicator in its simplest form. So we have the green line, which is the correlated basket, correlated to the euro, and the euro minus minus, which is inversely correlated to the euro, is effectively the US dollar relative to the euro. Now, the best way to use it in this format, or in this what we're seeing is to look at it in terms of divergence and convergence. So divergence is when these lines are moving away from each other. Convergence when they start and they come together. So what I'm going to do, I'm going to mark on some red lines here where I see convergences and divergences. All right, so this is a divergence. As you can see, the euro is coming down, but the US dollar is coming down in a quicker rate, and that accelerates. So the net result of that is, because the US dollar is coming down quicker or is diverging, price goes up. All right, up to this point here, when the opposite starts to happen. So we'll mark out this area here. Now, why does price come down here? The US dollar is getting stronger, the euro is getting weaker relative to each other, so price drops. All right, let's mark out to there. I'll move it across a bit to there. What's happening? There is prices effectively, we can see they're pretty much paralleling for most of that. That's the net result. And what you'll see is when you see the correlated, inversely correlated baskets parallel, you'll get price ranging. Why? Because one isn't necessarily stronger than the other. The euro and the US dollar, they're pretty well level pegging. It's like imagine a tug of war with a red ribbon in the middle. They're both playing as hard as the other, so price doesn't really do anything. Until this point here. What's happening now? US dollar is getting stronger. Euro is getting weaker. All right, they're converging. As a result, price drops. So we'll mark that out. Mark it to here. All right, now it starts to turn around. The euro is starting to get stronger and the US dollar is starting to get weaker. It turns around. Up to about roughly this point here. All right, now what's happening? Euro is getting weaker, US dollar is getting stronger. What's happening? Price drops. They're diverging. Let's make it a little bit easier to see. All right, from here, what's happening? US dollar is getting weaker. The euro currency is getting stronger. What happens? Price rises. Now, I'm trying not to cherry pick this. This is just an example. You can see that there's not a lot of, there are some trading opportunities in this, but they're short. But it is, the purpose of this is just to give you an appreciation of how this indicator works. All right. So price drops here. Why? You can see there is a divergence. Up to about here. US dollar is getting stronger. Euro is weakening. It's just to get a bit stronger, but it's still really they are diverging, causing price to drop. Now we'll go bar by bar. What's happening? All right. We'll stop it there. If you look what's happening here, US dollar is getting weaker. The euro is getting stronger. As a result, the euro USD climbs. All right, it's starting to weaken out relative to each other. Right, pause it there. So largely paralleling, we get ranging price, but then what happens? The euro gets much stronger than the US dollar. US dollar's coming off, euro's gaining strength. As a result, price goes up. So that's just a short example, and you can test this yourself. But yeah, when you look at the indicator in this simple, and I'd encourage you, back test it, try it on different currency pairs. on the 6 that we've got featured here on the indicator, and just look at things in terms of convergence and divergence. In the next video, the idea of this training series is to add layers as we go. So we're starting off from the very basics. Each video will introduce a new part of the indicator and perhaps a new concept, and yeah, we'll just keep building it. So I hope you found this useful, and see you in the next video.